Good morning, everyone. Hope you're doing well. If you're watching this, chances are the markets are a bit red today. Maybe you've seen a few percent wiped off your portfolio and you're wondering, what now? This video is an anchor, not just for today, but for any day the market crashes. Let me show you why this pain is relatively normal and what to do when it hits. This is going to be a very quick video on market crashes, why the market crashes, and then a bit of an extended part and how to deal with this. So first of all, let's start by zooming out. What looks like chaos today is often just noise in the much bigger picture, right? So here is just the last almost 20 years or so. Actually, since 1990, the S&P has dropped an average of about 14% at some point every single year. That's why drawdowns aren't necessarily bugs in the system. They're the price of admission. They're the price you're paying in order to have access to this market. I know it looks small now, but we've had crashes like, the dot-com, the great financial crash, and shorter ones like the COVID crash. Even more recently, the tariff crash. Each of them looked catastrophic in real time, but every single one was followed by a recovery and eventually new highs. I've just zoomed into the most recent crash, and really it's important to understand why they crashed. So companies could be reporting, lower earnings or a slowdown in growth. Fewer profits mean lower stock prices, right? Liquidity tightens. When the Fed raises rates, credit costs rise and money flows slower. Valuations could reset. Stocks have been running too hot for too long and they need to cool. And quite often the investor psychology is there, right? Fear spreads faster than fundamentals and crashes often follow excess. So too much optimism, too much leverage, too much price chasing. For example, when the VIX, Wall Street's fear index, spikes above 40, it usually means markets are bottoming. Historically, a VIX high has been followed by a strong 12-month return. So here you can see the VIX spiked recently, and then as it cooled, stocks began to rise. That's why the best buying opportunities often feel the worst in the moment. Now, if you're picking individual stocks, you need one thing above all: conviction. You can copy trades, and we all do it sometimes, but real conviction comes from actually doing the work, knowing the business, understanding the risks, and having a thesis. Because when your stock drops 30% or even more, and you don't really know what you own, you panic because you don't really understand it. But when you understand it, you stay calm, and maybe you even buy some more when they start hitting these target levels. So my advice would be really to understand and have a thorough process you go through in order to screen stocks. Mine is extremely simple. I read as much as I can on the economy, and I read a lot of free reports on where the economy is going. For example, the Institute for Supply Management releases a lot of interesting reports every month on how the US economy is doing. I then read through those reports and come up with ideas in sectors and themes. So once I've got an idea about a sector that might outperform, I'll start looking into the sector itself by downloading free data and going through different earnings multiples, including the PE ratio and the PEG ratio. I've actually done a separate video on the importance of these two ratios. I'll then find the said company and go through all of their investor relations website, including listening to the webcasts and even checking the CEOs on LinkedIn and seeing their past experiences. Really, guys, there's such a wealth of information out there, especially when you start really learning about a sector and what's driving growth. I'll start to look at their stock price and then wait for a good entry. I do this for every single stock in my portfolio. More than often, I'll look through a stock and I'll spend a few hours researching a sector and a stock, and I won't end up buying anything because the prices won't look good. Now and again, I'll find a gem and it will make me good money. Here's the real truth here. For most people, the best strategy is not stock picking. Most people do not have a decade of experience like me. And really the best thing that a lot of people can do, set up automatic contributions every paycheck into a low-cost index fund. It's called dollar cost averaging. Please just check out YouTube, and over time, it beats most active strategies. Even if you buy the top before a crash, history shows that consistent investing still wins. And even professional traders and mutual funds often underperform the S&P. Here's an example of a very popular mutual fund with $8.3 billion within it. It's likely that you'll be paying close to 1% a year of whatever money you invest into this fund just for the fees. Whereas, look, you're paying a lot of money for a lot more volatility, and really it's performing about the same as the S&P. So it's important when you have down days like this to zoom out, to reevaluate and to reassess your convictions. If you do feel shaky on days like today and it's impacting your mental health or your mood, you should reassess your strategy here. You either need to get better at investing and better at conviction within your stocks, or quit all that and just DCA into the S&P 500. That's all I've got to say today, guys. I hope you've enjoyed the video. Please subscribe if you would like more updated content. Thank you.